Welcome back to my channel. Interest rates are the hidden force that influences our daily lives, from the loans we take to the returns on our savings. But have you ever wondered why interest rates change? In today's video, we'll uncover the mystery behind interest rates and explore why they fluctuate. Let's start with the basics. What exactly are interest rates? Simply put, an interest rate is the cost of borrowing money or the reward for saving it. When you take out a loan, the interest rate determines how much extra you'll pay back over time. Conversely, when you save money in a bank, the interest rate dictates how much your savings will grow. Interest rates are expressed as a percentage of the principal amount. For example, if you borrow $1,000 at an interest rate of 5%, you'll pay back $1,050 over a year. Similarly, if you save $1,000 at a 5% interest rate, you'll earn $50 over a year. Before we continue, remember to like the video and subscribe to the channel. Now that we understand what interest rates are, let's delve into why they change. There are several factors at play, and it all starts with central banks. Central banks, like the Federal Reserve in the United States or the European Central Bank in the Eurozone, play a crucial role in setting interest rates. They do this primarily through their monetary policy. Central banks adjust interest rates to achieve their economic objectives, which usually include controlling inflation, managing employment levels, and ensuring economic stability. Let's break down these objectives. First, controlling inflation. Inflation is the rate at which the general level of prices for goods and services rises, eroding purchasing power. Central banks aim to keep inflation at a target level, usually around 2%. If inflation is too high, they might increase interest rates to cool down the economy. When interest rates rise, borrowing becomes more expensive, and saving becomes more attractive. This reduces consumer spending and business investment, slowing down the economy and helping to bring inflation under control. Conversely, if inflation is too low, central banks might lower interest rates to stimulate economic activity. Lower rates make borrowing cheaper and saving less rewarding, encouraging spending and investment. Next, managing employment levels. Central banks also use interest rates to influence employment. When the economy is growing too quickly and unemployment is very low, there's a risk of overheating, which can lead to high inflation. To prevent this, central banks may increase interest rates, which can slow down economic growth and keep the job market in check. On the other hand, if unemployment is high and the economy is sluggish, lowering interest rates can stimulate growth and help create jobs. Ensuring economic stability is another major goal. Central banks strive to create a stable economic environment where businesses can thrive and consumers can plan for the future. Interest rates are a key tool in achieving this balance. During times of economic uncertainty, central banks may adjust interest rates to stabilize financial markets and restore confidence. For instance, during a financial crisis, they might lower rates to support borrowing and spending, helping to stabilize the economy. While central banks are major players, other factors also influence interest rates. Let's explore some of these. Economic growth is one such factor. When the economy is strong and growing, demand for credit increases, which can drive up interest rates. Conversely, during a recession, demand for credit falls, leading to lower rates. Market demand for loans and savings also plays a role. If there's high demand for loans, banks might raise interest rates to maximize their returns. Similarly, if there's a lot of money being saved, banks might lower rates to discourage further savings. Global influences are another important factor. Interest rates in one country can be affected by rates in other countries. For instance, if interest rates in the US rise, it might attract foreign investors looking for higher returns, which can impact exchange rates and interest rates globally. Let's look closer at how these global influences work. In a globally connected economy, capital flows freely across borders in search of the best returns. When a country raises its interest rates, it becomes more attractive to investors looking for higher yields. This increased demand for the country's currency can drive up its value, impacting international trade and investment. On the other hand, if a major economy lowers its interest rates, it can prompt capital outflows as investors seek better returns elsewhere, affecting global liquidity and potentially leading to lower interest rates in other countries. Moreover, geopolitical events and international economic policies also play a role. For instance, trade wars, political instability, and changes in international trade agreements can create uncertainty and affect interest rate decisions by central banks worldwide. Now that we've covered why interest rates change, let's talk about how these changes affect you. Whether you're a borrower or a saver, interest rate changes can have a significant impact on your finances. For borrowers, higher interest rates mean higher costs for loans. This can affect everything from mortgages and car loans to credit card debt and student loans. If you're planning to take out a loan, it's important to keep an eye on interest rate trends. For instance, if you're looking to buy a home, a higher interest rate can significantly increase the cost of your mortgage over time. It's not just about the monthly payment. Over the life of a 30-year mortgage, even a small increase in the interest rate can add up to thousands of dollars in additional interest payments. Similarly, for auto loans, higher interest rates mean higher monthly payments, which can affect your budget and the total cost of the vehicle. For student loans, interest rates can impact your repayment plan and the total amount you'll pay back after graduation. For savers, higher interest rates are generally good news. They mean better returns on savings accounts, certificates of deposit, CDs, and other interest-bearing accounts. If you're saving for a goal, higher rates can help your money grow faster. However, there's a flip side. If you have existing debt with a variable interest rate, such as an adjustable rate mortgage or a credit card, rising interest rates can increase your monthly payments. It's crucial to understand the terms of your loans and consider fixed rate options if you're concerned about rising rates. Interest rates also affect the broader economy, influencing business decisions and investment. For businesses, higher interest rates can increase the cost of financing projects and expansion, potentially leading to reduced investment and slower economic growth. In the stock market, interest rate changes can impact stock prices. Higher interest rates can lead to lower stock prices as borrowing costs rise and companies' profits are squeezed. Conversely, lower interest rates can boost stock prices as borrowing becomes cheaper and consumer spending increases. Understanding why interest rates change and how they affect you can help you make more informed financial decisions. Whether you're borrowing, saving, or investing, staying informed about interest rate trends is key to managing your money effectively. For instance, if you're a saver, you might want to lock in higher rates with long-term CDs when interest rates are rising. If you're an investor, understanding how interest rates affect different sectors can help you make better investment choices. For borrowers, keeping an eye on interest rate trends can help you decide when to refinance or take out new loans. Thanks for watching. If you found this video helpful, don't forget to like, comment, and subscribe for more insights into the world of finance. And if you have any questions about interest rates, leave them in the comments below. Until next time, stay financially savvy.